Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
There's this illusion we all kind of walk around with every single day.
Oh, yeah.
Yeah, we think we understand the basic architecture of our own lives, right? You
Yeah.
wake up, you go to work, you check your bank account on payday, and you see that direct deposit hit.
Best feeling in the world.
Exactly. And it feels like this very simple, direct transaction between you and your boss. But right there, hidden in plain sight, is this invisible giant.
It really is the ultimate backstage operator of the modern economy.
It totally is.
Yeah.
And that is our mission for today's deep dive. We're unpacking a company that absolutely touches your life or, at least your bank account, likely without you ever realizing the sheer mind-boggling scale of it. We are talking about automatic data processing, which is better known as ADP.
And when you say scale, it really cannot be overstated. We aren't just talking about a popular piece of software here.
No, we really aren't. Here is the staggering fact that completely hooked me right out of the gate. ADP pays roughly 1/6 of all U.S. employees.
Yeah, that's huge.
1 out of every 6. And they don't just do this in America either. They operate in over 140 countries worldwide.
Which is just a massive logistical footprint.
Right. So to really understand how this quiet titan works, we are pulling from this incredibly detailed research report by Compasscope, alongside the hot-off-the-press ADP Q2 2026 earnings call transcript.
What's so compelling about that Compasscope research is that it really forces you to look under the hood. To understand how this company actually makes its money, you have to examine a deeply embedded business model.
Yeah.
Because paying 1/6 of a country's workforce, it isn't just a software feature, it is an entirely unique economic engine.
Okay, so let's unpack that engine, because to understand how ADP touches so many lives and businesses, we really have to break down its main lines of business.
Right, the core pillars.
Yeah, and from the Compasscope report, the first big one is employer services, or ES. This is the core software and outsourcing side.
Right.
And they cover the entire spectrum of company sizes.
Which is key to their dominance.
Exactly. So for small businesses, they have a platform called RUN. For the mid-market, they use Workforce Now NextGen. And for massive global enterprises, they have this flagship platform called ADP Lyric.
Yeah, Lyric has been a game changer for them lately.
And they're doing everything from basic U.S. payroll to incredibly complex multi-state tax filing, benefits administration, and time management.
Right, and employer services is what most people picture when they think of ADP. It's the software portal where you go to request time off or view your pay stub. It is the digital infrastructure of human resources.
But then there's the second engine, which I just found totally wild. It's called PEO Services, which stands for Professional Employer Organization.
Ah, yes, the PEO model.
Yeah, this is a co-employment model. ADP literally shares employer responsibilities with their clients. So I'm trying to visualize this. Why would a business owner voluntarily hand over that much control, legally speaking, to an external company?
Well, look at it from the perspective of a small business owner. Imagine you run a 50-person tech startup or maybe a mid-sized property management firm.
Okay.
The administrative and regulatory burden of managing payroll taxes, keeping up with constantly changing employment laws, dealing with HR compliance, it's absolutely crushing.
I'm sure. It takes your entire focus away from whatever it is your business actually does.
Right. You're spending all your time figuring out state tax codes instead of, actually building your product.
That makes sense.
But the absolute biggest draw of the PEO model is the benefits pooling. A 50-person company just cannot negotiate health insurance rates the way a massive corporation can. They just don't have the leverage.
Obviously not.
But because ADP is acting as a legal co-employer for hundreds of thousands of workers across thousands of different companies, they take your 50-person startup and bundle it into this massive national risk pool.
So suddenly, because you are co-employed by ADP, your tiny startup is negotiating with the bargaining power of a Fortune 500 giant.
Precisely. That small business can now offer top-tier health, dental, and vision benefits. They hand over control because it is the only way they can compete for top talent against the corporate giants, while simultaneously offloading a massive legal and compliance headache.
Wow. Okay, so that is employer services and the PEO model. But the Compasscope report highlights a third, completely hidden line of business that absolutely blew my mind.
The float.
The float, also known as client funds. I never really thought about the timeline of how a paycheck actually works.
Most people don't. They just know Friday's payday and the money shows up.
Right. But let's walk through that timeline. If a business wants its employees paid on Friday, they don't just send the money on Friday morning. They transfer that payroll cash to ADP on, say, Tuesday or Wednesday.
Correct.
And ADP doesn't disperse it until Friday. So for 2 or 3 days, ADP is just holding that money, and before they actually distribute it to employees or tax agencies, they invest it.
They do, and it's brilliant.
When you are processing payroll for a sixth of the U.S. workforce, you are holding a mountain of cash, and that cash is generating massive interest income every single day.
And that float is a crucial, incredibly high-margin profit center. They are essentially acting as a fiduciary in that interstitial window.
It's basically free money for them.
Well, it's a structural advantage that purely software-based competitors simply do not have.
Making $1 billion just for holding money sounds like an absolute dream business model.
Yeah.
Which kind of begs the question, why isn't every Silicon Valley software giant cannibalizing this market?
Oh, they've tried.
Let's look at their competitors and their overarching competitiveness then. Because ADP is so deeply embedded into a company's operations, through the software, the co-employment, and the fund management, it creates this massive defensive moat.
A moat built largely on the sheer terror of messing up payroll. I mean, the CompuScope report notes they have a sustained gross revenue retention rate of around 92%.
Wow. 92%.
Yeah, that means year after year, 92% of their revenue simply stays put.
Because the switching costs are astronomical. Like if you upgrade your marketing software and it glitches, maybe you lose a few leads.
Yeah, it's an annoyance.
But if you mess up payroll or miscalculate taxes, you get massive fines from the government and an absolute mutiny from furious employees. You do not just casually swap out your payroll provider to save a few bucks.
You really don't. And that intense stickiness defines the battlefield they're fighting on. In the small business arena, ADP is fighting it out primarily with Paychex and Intuit, the makers of QuickBooks.
Okay, those are the familiar names.
But in the enterprise and cloud space, the battlefield is full of absolute titans. They are facing Workday, Oracle, SAP, UKG, and Ceridian's Dayforce.
Wait, I'm trying to wrap my head around this. If I'm a massive multinational corporation, and I am already paying millions of dollars to use Workday or Oracle for all my core enterprise resource planning, my overarching HR, my global databases, why wouldn't I just use them to cut the checks?
It seems like the logical next step, right?
Yeah. Why use a completely different company just for payroll? It seems incredibly inefficient.
It's a great question, and the answer comes down to the fundamental difference between writing software and executing compliance.
Okay, explain that.
So, software is just code. A company like Workday builds brilliant, unified databases. But running actual payroll in 140 different countries is a legal minefield. Every single country, and often every local municipality, has its own bizarre tax regimes, social insurance laws, and labor regulations.
So it's not just doing the math to figure out hourly wages.
Exactly. It's knowing which math is legally required in a specific zip code in Germany versus a county in California. And the laws change constantly.
Right.
ADP doesn't just provide the software dashboard, they actually take on the execution risk. They have decades of track record of local in-country compliance and the physical infrastructure to ensure the money moves legally and accurately.
That makes total sense.
Pure software companies can build a beautiful user interface, but they cannot easily replicate that massive global legal execution engine. That is ADP's unique competitive edge.
So how does a company that is already this embedded, that already pays 1/6 of America, keep growing? I mean, they can't just rely on inertia.
No, you always have to be looking forward.
Right. And the CompuScope report details their growth strategy, and they're pulling some highly strategic levers. First is a massive tech and AI expansion. They're migrating mid-market clients to that NextGen platform and aggressively selling ADP Lyric to massive enterprises. Plus, they're deploying something called ADP Assist.
Yeah, ADP Assist is really interesting. These are generative AI agents embedded directly into the workflow.
Like a chatbot?
More powerful than that. So instead of an HR manager clicking through 50 menus to find out why a tax ID is missing or trying to figure out how to process a mid-cycle promotion, they can just type what they want to do in plain English.
Oh, wow.
And the AI agent scours the system, identifies the issue, or initiates the workflow automatically.
That is super efficient. And beyond just the tech upgrades, they're targeting major international upside. They are going after those massive global enterprises.
Which is where Lyric really shines.
Exactly. I saw on the Q2 earnings call, they just announced they scored a 75,000 employee European bank.
That's a massive win.
Huge.
Yeah.
And they won it by combining their global payroll execution with their newly acquired workforce software suite, offering this massive bank a completely unified global system for time tracking, pay, and HR.
It is all about capturing the complex global end of the market, but they're also making fascinating moves at the small business end.
Yes, I saw this in the report and it fascinated me. Embedded finance. They're integrating a tool called Fiserv Cashflow Central directly into their ORUN platform for small businesses.
So they're basically doing bill pay now too.
Exactly, and it's actually a genius trap.
A trap. Think about it. Historically, a small business owner uses ADP for payroll, maybe a bank portal to pay vendors, and another software to send invoices to customers. By embedding Fiserv directly into the RUN dashboard, that business owner isn't just doing payroll there anymore.
Oh, I see where this is going.
They are managing accounts payable, accounts receivable, paying their vendors, and sending invoices all from the ADP screen.
Oh, wow. If you do all your invoicing, pay your suppliers, and run your payroll in one single dashboard, the switching cost becomes basically infinite. You are never, ever leaving.
The real subtext here is what the industry calls attach rates. ADP's underlying growth strategy isn't just about hunting for brand new clients. It is about making their current base of over 1 million clients deeply, inextricably reliant on them.
By attaching all these extra services.
Right. They attach retirement services, health insurance, these embedded finance tools, and AI capabilities.
And the Contoscope report mentioned this strategy gives them roughly 100 basis points of annual pricing power.
Right. And by 100 basis points, we mean ADP can essentially raise their prices by 1% every single year, and clients will just accept it and pay it.
Because leaving is too hard.
Exactly. The alternative, untangling their entire financial nervous system to switch providers, is just too painful. They become the central nervous system of the business.
But becoming that central nervous system comes with a terrifying downside, which brings us to execution risk. If you are the heart pumping the money, what happens if you skip a beat?
It's not pretty.
The operational complexity here is staggering. You are managing multiple generations of platforms simultaneously. You have legacy systems that have been running for decades, alongside RUN, Workforce Now, and the new Lyric platform.
Upgrading the systems without breaking a mission-critical payroll run is incredibly delicate. It is like trying to replace the foundation of a house while the family is still living inside it, and they happen to be throwing a dinner party.
That sounds incredibly stressful.
It is. You have to route the plumbing and the electricity to the new pipes without the lights ever flickering. Because if the lights flicker, people don't get paid.
And if people don't get paid, the consequences are disastrous.
Yeah.
Not to mention, they are holding the most sensitive financial and personal data imaginable. Social security numbers, bank routing numbers, home addresses for tens of millions of people.
Which makes them a massive target.
Right. Cybersecurity is a paramount execution risk. One major breach could completely erode that 92% retention moat overnight. Trust is their actual product.
Trust and accuracy. And that execution risk extends to their other business lines, too. On the PEO side, they face massive underwriting risk.
How so? Because they are pooling the health benefits.
Exactly. When ADP pools hundreds of thousands of workers to negotiate health insurance, they have to estimate how much health care those workers are actually going to use. If they guess wrong, if they misprice the health benefits, or underwrite a risk pool that ends up having significantly higher medical claims than expected, ADP eats that cost, it cuts directly into their PEO margins.
That makes sense. But going back to the tech side, I have a somewhat provocative question about this new AI push.
Let's hear it.
We talked about ADP Assist using generative AI to handle HR actions and process data across 140 countries. What happens if the AI hallucinates a tax code? Like if it files something wrong or miscalculates withholding based on an AI error, who takes the blame?
Well, that is the absolute core risk of their modernization strategy. They have to balance rapid AI innovation against incredibly rigid governance and compliance.
Right, because the stakes are real money.
Exactly. In the payroll world, the Silicon Valley mantra of move fast and break things is a terrible, terrible motto. You cannot break a worker's ability to pay their rent.
No, you definitely cannot.
Ensuring that AI outputs are accurate, explainable, and fully compliant across diverse global legal jurisdictions is a monumental execution challenge. They have to innovate, but they have to do it with zero margin for error.
And finally, there's the macro execution risk tied to that hidden engine we talked about earlier, the float. If central banks decide to slash interest rates, the yield on that massive pool of client funds drops.
Which is entirely out of their control.
Right. That high-margin interest income can evaporate through no fault of ADP's own operations. They are highly sensitive to the broader economic environment.
Which is actually the perfect lens through which to look at how they are navigating this exact environment right now. The Q2 2026 earnings call gave us some hard empirical data on their recent business updates and current trends.
Yeah, let's contextualize these numbers, because if you want proof that this sticky, deeply embedded strategy is working, just look at their Q2 results. The company posted 6% overall revenue growth, 80 basis points of margin expansion, and an 11% jump in earnings per share.
Very solid numbers.
And they're using that cash generation to authorize a massive new $6 billion share buyback. So the financial engine is clearly humming. But maybe more importantly for the long term, they hit their highest single best quarter for client satisfaction in ADP history. Whatever they are doing with these new platform rollouts, the clients are actually loving it.
And the pipeline data supports that enthusiasm, especially in the complex enterprise space. ADP Lyric is absolutely crushing its targets. Over 70% of Lyric's new business pipeline is coming from new logos.
Meaning these aren't just existing ADP clients upgrading their software.
Exactly. They are actively stealing massive clients away from competitors. In the call, they specifically highlighted signing 2 separate companies with over 20,000 employees each in just this one quarter.
Oh.
Yeah, that proves their global compliance engine is winning out over pure software players.
On the flip side, though, the PEO growth did moderate a bit. PEO worksite employee growth slowed slightly to 2%. They noted this was due to slightly softer bookings and, interestingly, a normalization of post-pandemic out-of-business rates.
Right, the macro environment tightening up.
Basically, during the post-pandemic boom, very few businesses failed. Now, small businesses are facing a tougher, more normal economic reality. And when small businesses close, ADP's PEO numbers dip. But speaking of the macroeconomy, there was one detail from the earnings call that absolutely stopped me in my tracks. It was about AI and jobs.
The macro labor commentary from the executives.
Yes. You hear these doom and gloom headlines every single day about AI coming for white-collar jobs, mass corporate layoffs because algorithms are doing the work. But ADP literally has the receipts on hiring trends for 1/6 of the country.
And what did the receipts say?
The executive stated flat out on the call, there is no evidence of AI driving mass corporate layoffs right now. They looked across their industry data in tech, finance, professional services, the exact places you would expect AI to replace people, and they said it's simply not happening in the data yet. Layoffs remain historically low.
What is so fascinating here is that ADP acts as an empirical reality check against the media hype. They don't have to guess about the labor market. They process the actual payroll.
It's pure hard data.
And connecting their Q2 financial performance back to their overall strategy, their executives noted that their margin expansion in the back half of the year is going to rely heavily on 2 things. First, tech-driven productivity, basically using their own AI to serve clients more efficiently. And second, that massive client funds balance.
The float strikes again.
Precisely. Because interest rates have remained relatively elevated, they actually just revised their float revenue guidance up. They are now expecting the client funds to generate between $1.31 and $1.33 billion in pure interest revenue for the year.
$1.3 billion just for holding the money. Unbelievable. Okay, to wrap up this portfolio of knowledge on ADP, let's talk about the keys to watch. If you are following this company going forward, what are the exact metrics and trends you should be paying attention to? The ComScope report lays out a few critical ones. First is the health of the labor market, specifically a metric they call pays per control.
Right. Pays per control is basically industry jargon for how many individual employees their existing clients have on the payroll.
Okay.
If a client goes from 50 employees to 45, that's a drop in pays per control. If small businesses stop hiring or start failing, ADP feels it in their revenue before almost anyone else.
Got it. Second, you absolutely have to watch interest rates. We just mentioned the float generating over $1.3 billion. Central bank rate cuts directly and immediately compress their yield on those funds. Keep an eye on the Federal Reserve.
Why?
Not just for what it means for your mortgage rates, but because a quarter-point rate cut literally costs a software giant like ADP millions of dollars in pure profit.
You also need to watch the PEO margin. Healthcare cost inflation is a very real threat right now. Can ADP maintain the profitability of that co-employment model without passing so much of the rising healthcare costs onto their clients that the value proposition of pooling breaks down?
That's a delicate balance. And finally, track their enterprise AI adoption. Will the momentum of Lyric and Workforce Now NextGen continue to win those massive 20,000-plus employee global deals against the cloud-native competitors like Workday?
If we pull all of these moving parts together, ADP represents this beautiful corporate paradox.
How so?
Well, on one hand, it is a highly predictable, incredibly sticky software and services business with 92% retention. But on the exact same hand, its ultimate profitability is uniquely tethered to the chaotic, unpredictable realities of macro employment health, wage inflation, and global central bank interest rates.
So we've gone from the invisible giant paying your salary to embedded finance traps, AI hallucinations, and billion-dollar interest floats. We have looked at their software engines and their macro risks. Is there anything we're missing before we close the book on ADP?
Actually, yes. There is an undeniable subtext to everything we just talked about that wasn't explicitly laid out in the strategy sections, but it might be their most valuable asset of all. Data visibility.
How do you mean? What kind of data?
Think about the sheer volume of insight they possess. If they are processing pay for 1/6 of the entire U.S. workforce and over 16 million global workers, they see everything.
Oh, wow.
Their real-time visibility into wage inflation, sector-by-sector hiring trends, and overarching economic health is likely faster, deeper, and more accurate than official government reports. In a rapidly shifting, data-driven world, ADP isn't just a payroll company. They're actually sitting on the ultimate economic crystal ball. They see the shifts in the global economy weeks, if not months, before the official statistics are ever published.
Now, that is a profound thought. Definitely something to keep in mind the next time you see that direct deposit hit your account. Thank you for joining us on this deep dive. Keep looking beneath the surface of the companies that quietly run our daily lives.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.